IV channel. We are very, very happy that we have this time even more participants than the last time, at least registered. We currently have 37 attendees online, so I would like to ask you to wait 1 minute more, and then we directly start with the presentation. Give us just 1 minute. Thank you. Okay, ladies and gentlemen, even if not already all registered persons are in the webinar, I think we should start because we always try to stay in the time we planned. Welcome everybody to our second episode of the Basel IV channel. Today's topic is the second consultation paper on the revisions to the standardized approach for credit risk. Before we start, of course, with the presentation, we would like to introduce ourselves. My name is Neisen. I'm the Global Basel IV leader, and I'm located in Frankfurt, Germany. And today I have two co-speakers. The first one is Lucinda. Lucinda, you would like to introduce yourself?
Yeah, sure. Hello, everybody. My name is Lucinda Dean, and I'm a director in our UK regulatory team, and I'm based in London. And I've been working on prudential regulation for nearly 15 years now. So back in the day with Basel II, in Basel III implementation, and now very much focused on Basel IV. Thank you.
Thank you very much, Lucy. Great to have you today here on the call. And the second co-speaker is Stefan.
Hi everyone, my name is Stefan Röth. I'm Senior Manager at PwC in Germany, working within the Regulatory Management Department of Neisen.
Thank you very much, Stefan. Before we actually start with the presentation on the revisions to the standardized approach, I would like to give you some more background information about the Basel IV channel and what the idea behind is. When we started the Global Basel IV initiative, we thought about what is the best way to inform our clients about the latest developments from the Basel Committee. And of course, we thought about sending out newsletters, both by post, simply writing letters, but also sending emails. But in the end, we said, okay, when we send it by post, it's not good for the environment, and also the risk is too high that somebody will throw the letters, and then it was for nothing. And the second alternative to send out emails, there the risk is too high that it gets to the spam folder. So we said we go a complete new way and try a more interactive newsletter. So we have set this webinar, which is called the Basel IV channel, and we plan to do this Basel IV channel every 4 weeks. And in the Basel IV channel, we would like to inform you about the latest developments coming from Basel, but also giving you a little bit more detailed insights into the new approaches proposed by the Basel Committee. So what is our plan for today? Of course, first we want to give you some more background information about what we call Basel IV, because something that we always have to remember, the Basel Committee still denies the existence of something that is called Basel IV, even when all the approaches for the calculation of risk-weighted assets will be changed in the next years. A little bit strange that you are not able to call it Basel IV, but to make it simple, we call it Basel IV. And then we will give you a very, very quick overview about the current standardized approach on credit risk. And then, of course, the main focus will be the second consultation paper on the revisions to the standardized approach for credit risk. And last but not least, of course, we would like to give you the first insights on the impact and conclusion what this means to the banks. Yeah, maybe quickly, what is Basel IV about? Maybe this slide gives you a good understanding on how the focus of Basel IV is. Because it's pretty much like a formula for calculating capital ratios. You have in the nominator the own funds or the capital, in the denominator you have the risk-weighted assets or the capital requirements. While the focus of Basel III was completely on own funds and capital, we had new capital ratios, capital buffers, deduction positions, and so on and so forth. Of course, we also had a leverage ratio and liquidity requirements, but that's not fitting into this formula. And this will be changed completely under Basel IV because the focus will be not capital, it will be 100% the risk-weighted assets or the so-called capital requirements. And you can say many things about the Basel Committee, but definitely not that they are lazy or that they are not fair, because they have no favorite risk type. That's the reason why they changed the approaches for the calculation of risk-weighted assets for all risk types. So no matter if we are talking about credit risk, market risk, or operational risk, all approaches, and no matter if it's a standardized approach or an internal model approach, they will be changed all. And currently we have different status depending on the proposals. For example, for the standardized approach for counterparty credit risk, we have already a finalized paper, or for the securitization framework, while, for example, our topic today for the standardized approach on credit risk, we are still in the consultation phase. That's a quick overview of what Basel IV is about, but I don't want to make you wait too long, so let's go into the standardized approach. Lucy, would you like to take over?
Thank you, Martin. So just to recap, I mean, we wanted to just set out just what's the motivation for the revised standardized approach. And as you'll see on slide 6, that the committee's proposals are seeking to address the perceived weaknesses they believe exist in the current regime, namely around the general lack of risk sensitivity of the current requirements, the mechanistic reliance on external ratings, as well as the lack of comparability across territories due to the impact of national discretions. So we have the December 15 proposals, which is in the CP. As you'll know, the Basel issued its very first consultation on this topic back in December 2014. And the proposals do differ in many ways from that first consultation. And these are largely in response to industry feedback of the limitations of the sort of initial proposals, which related to removing all reference to external ratings. So what the latest proposals do, as we'll talk you through, is that they reinstate the use of external ratings for bank and corporate exposures. And also there's been additional modifications to those original proposals in respect of real estate exposures. I think it's important to note that these latest proposals don't include exposures and revisions to exposures to sovereigns or public sector. We understand that the Basel Committee is actually holding off finalising its review at the moment until it's completed its sort of holistic review, if you like, of the impact of all the proposals. So we expect this sovereign review and proposals on sovereign exposures to be coming out at some point in 2017. Stefan, shall I hand over to you to talk about the capital floors?
Thank you, Lucy. And you may be wondering, if we are talking about the standardized approach for credit risk, you may think, hey, I'm working at an IRB bank. How does it impact me when they change the standardized approach? Well, I'm sorry, it will impact you in a major way, because the Basel Committee clearly communicated its plan to introduce floors for risk-weighted assets based on the standardized approaches. So everyone working at an internal model bank will have to implement the standardized approaches as well, is forced to calculate risk-weighted assets based on the standardized approaches for the complete portfolio and not only limited to those positions subject to partial use. And of course, there will be a floor being set by the Basel Committee, probably in the range of 60 to 90%. Unfortunately, we still didn't invent a looking glass, so we cannot predict where it will be in the end, but the Basel Committee said between 60 and 90%. So this revisions to the standardized approach will have a profound impact on internal rating-based banks as well, and this is no surprise given the motivation that you can see here on slide number 7, all the problems that the Basel Committee identified with regard to internal models, and of course therefore strives to limit the amount of freedom that banks have in using internal models to calculate risk-weighted assets. Now, that's about all I would like to mention at this point of view, and therefore hand over back to you, Lucy, with a short overview of the second consultation paper.
Thanks, Stefan. I think before we move on to the detailed proposals themselves, just to recap on timing, we expect the committee to issue its final proposals by the end of this year, after it's reviewed the results of the various QISs, which are out there with the industry at the moment. But in our view, you know, the committee's objectives haven't changed since they put the paper out last December. We therefore expect the final proposals will have a significant impact on banks, and whether this is through, you know, higher RWAs or through the enhancements that banks will need to make to their existing credit risk processes more generally. So Stefan, shall I hand over to you to start walking through the requirements in some more detail?
And we start with exposures to banks, and here you can basically see what Lucy just mentioned. External ratings are back. If you look at the left-hand side of the slide, you can see a mapping table from external ratings to risk weights. And if you are really deep into the current standardized approach, you may think, hey, nothing changed. It's still the same risk weights. Basically true, but now they are called base risk weights. Why are they called base risk weights? Because you cannot stop here, but you have to move one step further by doing a due diligence. And as part of your credit risk processes, you will have to do this due diligence to find out whether the external ratings adequately reflect the credit risk associated with the position. And if you find out that this is not the case because the external rating underestimates the credit risk, then you have to move to a higher risk weight. And no great surprise, you may never move to a lower risk weight, only to higher risk weights. Should you have positions to unrated institutions, or should you be living in jurisdictions where external ratings are not allowed for regulatory purposes, we move to the right-hand side of the slide and the so-called standardized credit risk assessment approach, which from some commentators has already been dubbed the introduction of an internal model by the back door, because here for unrated exposures, banks have to make a due diligence, group those exposures into 3 grades called A, B, and C, and assign risk weights based on these 3 grades. Now, the question, of course, is how do we assign positions to grades? There are 2 types of parameters you have to look at. The first one is whether banks exceed or meet their minimum regulatory requirements, like risk-based capital ratios, buffer ratios, and so on and so forth. But also, the Basel Committee wrote that positions which are subject to substantial credit risk shall be assigned to grade B, and positions that are subject to material default risk must be assigned to grade C. So here, once again, you could use internal ratings to find out whether a position is subject to substantial credit risk or even material default risk, and therefore we have this rather strange situation that internal ratings may be used for the assignment of risk weights in a standardized approach. Now, Lucy, can you show us what the impact will be?
Of course. So as you'll see from this slide, we've selected a handful of European banks, and you'll see that under the latest proposals, the risk weights remain the same as under the current standardised approach. But as Stefan has pointed out, that assumes that no adverse outcome comes from the due diligence exercise that you've conducted. I think what this slide also does is it highlights the increase in RWAs that would have resulted if the committee's initial proposals from December 14, which were to prevent the use of external ratings, had been maintained. Okay, moving on to the next slide. So for multilateral development banks, the committee has proposed maintaining the current 0% risk weight for eligible multilateral development banks. As I mentioned before, the committee will be reviewing exposures to sovereigns and central banks, etc., as part of a more holistic review of sovereign-related risk. So pending this risk, helpfully, they proposed keeping the status quo, if you like. And what they've also clarified, again helpfully, is that where multilateral development banks have subsequently been downgraded, they're permitted to remain on the eligible list to avoid multiple changes to the list and hence the availability of the 0% risk weight. Stefan, shall I hand over to you?
And we continue with the exposure class of corporates, and here the picture is rather similar to the one I just presented with regard to institutions. External ratings are back. The lookup table for the risk weight might seem very familiar to you, and once again we have this requirement for a due diligence to find out whether a higher risk weight may be appropriate. There is one exception, which is unrated corporate SMEs, which will receive an 85% risk weight according to the Basel Committee. The interesting question here is whether the so-called SME exemption in the CRR, you know, that strange factor of 76.19%, will survive if a flat risk weight of 85% for SMEs is introduced. And also similar to institutions, if no external ratings are available or allowed within a jurisdiction, there is a second approach which requires a flat risk weight of 100% for all corporate exposures, two exemptions, one for SMEs with 85% and one for investment grade exposures with 75%. And here once again the interesting question is how to determine whether an exposure is to an investment grade corporate. And here once again the possibility may be to use internal ratings to find out whether a position is investment grade and therefore assign a risk weight within the standardized approach. We can also have a look at what this would mean in practice. On this slide you can see the risk weights depending on the external ratings according to the current standardized approach under CRR, according to the new Basel Committee consultation paper, and you can also see risk weights for corporates under the IRB approach that thankfully were published by the EBA in 2015, and you can see that in almost all cases the IRB approach still offers significantly lower risk-weighted assets than the standardized approach, however, without taking into account the upcoming rules for a capital floor. And therefore, back to you, Lucy.
Thank you. So moving on to retail exposures now, on slide 14. So for retail unsecured, Basel proposes maintaining the current 75% risk weight, although they have introduced more granular criteria that needs to be met to classify exposures as retail. And just to be clear, this is in respect of unsecured retail exposures. So the additional granular criteria, these relate to the type of product. So specific products such as derivatives cannot be risk-weighted or treated as a retail exposure. And in addition, they've introduced sort of more granular criterion such that aggregate exposures to a particular retail counterpart has to be below 0.2% of the bank's overall retail portfolio. If these criteria aren't met, then the risk weight increases to 100%. So what does this mean? Banks will need to implement sort of appropriate monitoring process and controls to ensure that they're in compliance with this new criteria, and in particular, they're monitoring the new cap. Moving on to retail mortgages, retail secured. The latest proposals, I think it's fair to say, are expected to have a material impact on banks, and it's not just potential increases in RWAs, but it's also on the systems, processes and controls that are resulting from the new operational requirements that they're proposing. So what do the latest proposals do? Well, they include additional taxonomy for classifying exposures, for example, distinguishing between exposures which are what they call income-producing real estate. So that's where repayment is materially dependent on cash flows of the property, such as buy-to-let. And they've also introduced a category called land acquisition, development and construction. In addition, what they've done is they've introduced operational requirements, and if these operational requirements aren't met, more punitive risk weights apply. So these operational requirements relate to valuations, underwriting standards, the claim the bank has on the property, and whether the property is in a final state or not. In addition, the revised risk weights are clearly a lot more sensitive to LTVs, and it's fair to say that overall they're more punitive than the risk weights under the current regime. So there's some big impacts for residential real estate exposures.
And the same, unfortunately, is true for commercial real estate as well. You can see that the rules are quite similar. We have the general treatment based on operational requirements and the LTV. We have specific rules for income-producing real estate and ADC exposures, which will have much higher risk weights. And on the very right-hand side of the slide, you can also see a short list of those operational requirements for real estate exposures. At least in Germany, most banks seem to be of the opinion that they already fulfill most of those requirements, maybe with the exception of finished property, because if it is an unfinished property, we would probably be talking about ADC with a 150% risk weight, which is quite some increase as compared to the current rules. And this comparison is shown in more detail on the next slide, where you can see the risk weights depending on the LTV ratio. And what you can also see on this slide, what always uses to surprise me, is that there are some constellations in which exposure secured by real estate will attract a risk weight of 120 or even 130%, even though unsecured exposures to the same counterparty would attract much lower risk weights. And I'm really curious if this will be changed in the next consultation paper or the final paper, because it clearly sets some rather strange incentives for the banks with regard to collateralizing their exposures. And coming to the next slide, we also have a close relationship between real estate exposures and specialized lending exposures. The separate exposure class of specialized lending within the standardized approach was introduced by the first consultation paper. Now the second consultation paper clearly or more clearly distinguishes between real estate collateral on the one hand side and specialized lending on the other side. Specialized lending will be object and commodity finance, project finance in a pre-operational and operational phase, with flat risk weights of 100, 120 and 150%. And what is also important, there is the possibility to use issue-specific external ratings. However, in practice, most of those specialized lending exposures won't have external ratings, and therefore we end up with those rather conservative flat risk rates that I just told you about. And talking about flat risk weights, that is a very good topic also for the next slide, where you can see subordinated debt, equity, and other capital instruments, as well as other assets. To start with the other assets on the right-hand side, here basically the flat risk weight of 100% remains into place that we already know from the CRR, with some minor exceptions. Much more interesting is the left-hand side with equity holdings, which will attract a risk weight of 250%, while all other subordinated debt and capital instruments will attract a risk weight of 150%, which is also much less punitive than the first consultation paper, which required risk weights of up to 400% for those positions. And therefore, I hand back to you, Lucy, and the additional requirements.
Thank you. The committee has proposed a number of requirements impacting other types of exposure, for example, defaulted exposures, off-balance sheet exposures, and introducing additional add-ons for currency mismatches. I think the key messages to note from this is that for off-balance sheet exposures, they have floored the conversion factor at 10%. So banks can no longer apply the 0% credit conversion factor for unconditionally cancelable exposures, which was typically used for retail credit cards. In addition, this 10 to 20% bucket for unconditionally cancelable is not permitted for non-retail exposures, so it's only limited now to retail exposures. I think secondly, banks will need to apply an additional add-on where the lending currency differs from the currency of the borrower's main source of income. Clearly, this raises significant or potential significant operational challenges for banks in terms of how they actually ascertain whether a borrower is hedged or not its underlying position. So it'll be interesting to see whether that proposal remains in the final set of requirements.
And the last set of changes is regarding credit risk mitigation. And here we find a wonderful formula that I would so very much like to go into in all the necessary detail. But in order not to bore you, let's just put it like this. In case of netting agreements for securities financing transactions, the Basel Committee accepted that the current formula doesn't adequately reflect all the diversification that there is if multiple securities are used as collateral, and therefore introduced this formula. You can see weighting by 40 and 60% that some of you might remember from the current exposure method for a counterparty credit risk, and this shall more adequately reflect the diversification and correlation benefits from having a large netting sets with a large number of securities as collateral. And I hope it will suffice with this. And if you are interested in learning more about this wonderful formula, we will show you our contact details in just a few slides.
Thank you very much, Stefan. Thank you very much, Lucy. It was really great to listen to you guys. I think you really are in the details, and it's very, very interesting. As you were able to hear now and to see, of course, the Basel Committee is proposing changes in all exposure classes, and also the approach itself, the standardized approach, is changing a lot. So it's really strange that the Basel Committee is still insisting that this is a recalibration of Basel III rather than Basel IV. But I don't want to stress that topic. Maybe some highlights that we just heard. The first important thing is back to the roots. The Basel Committee is reintroducing the external ratings, especially for the exposure classes, banks and corporates. I think there it's really material. Nevertheless, we will in the future, especially on a global level, see a lot of differences between the risk weights for the exposure class banks because the regulators can choose whether they want to use external ratings or not external ratings. And I probably can say that in the European Union, the external ratings will be the material input factor for the risk weight, so there will be not much change. While on the other side, in the United States, it's already right now forbidden to use external ratings for regulatory purposes. So they will use the non-external rating-based approach. This means, especially for the standardized approach, you will not be able to compare anymore the risk weights for the exposure class banks between the United States and the European Union. And I think that's not the best thing. So I guess the Basel Committee will change some things on that. And also what is important for the exposure class banks is that in the European Union we still have quite a lot of banks. We have altogether 7,000 banks in the European Union, and more than 6,000 of these banks are not externally rated. So all these not externally rated will receive at least a risk weight of 50%, which is much higher than mostly they receive now when they are not externally rated, because they receive right now a risk weight of 20%. This will have a huge impact of interbank business, definitely. When we talk about the corporate exposure class, of course, here we also have the step back from the Basel Committee that they reintroduce the external ratings. If you use an external rating for deriving your risk rate, the impact will be not so big. But of course, if your due diligence results in a higher risk rate, of course, there will be an impact. I think there will be the much bigger impact for the IRB bank, depending on how high the floor is. So we are really keen to see how the Basel Committee will calibrate that. When we look to the retail mortgages, here I must say it highly depends on the local markets what the impact will be. If you are in a market where the standard is that retail mortgages have a traditional very low loan-to-value, the impact might be not so big. Even some banks will profit from it. In markets where you traditionally have very high loan-to-values, the impact will be very big because the risk weights will increase a lot. Only to give you an example, to compare these two markets, in Germany we have traditionally very low loan-to-values, while, for example, in the Netherlands we have rather high loan-to-values. There you can see the impact might be very different. Another important point here for the mortgages is that you have to fulfill these operational requirements, especially the new requirement of a finished property. That means, from a pricing perspective, a big challenge, because you will have different risk weights depending on the phase of the credit. Like in the beginning, when the building is still under construction, you have 150% risk weight, while in the end you have a risk weight based on the loan-to-value. Yeah, a big challenge, definitely. Last but not least, I would like to give you an indication what the overall impact might be. We performed with quite a number of institutions throughout Europe test calculations for the standardized approach, both for the first consultation paper and now for the second consultation paper. In the first consultation paper, the impact was even bigger. We were up to 50% higher capital requirements for the standardized approach, while now in the second consultation paper we have in average an increase of 30%, but I think even 30% is a huge increase. So if you are interested also in performing such a test calculation, do not hesitate to contact us. We as your speakers, thank you again Lucy, thank you again Stefan. Of course, you can contact us if you have any questions about the standardized approach, about Basel IV in total, but also, of course, you can contact your local Basel IV specialists. We have added here all the names in this slide. And as always, we will publish this webinar. We recorded it on our YouTube channel, so you will be definitely able to watch this session again. So thank you very much for your attention. Thank you again, Stefan and Lucy, for your speeches. And yeah, I hope to hear from you soon. And have a nice weekend. Bye-bye.